whilst we're in a market like this, if you can put money to work alongside the rest of the market, you're leveraging your chances of success, being able to spread yourself across a fair few more opportunities, I guess.
Early stage exploration risk is a job for the public markets. And the public market's doing a good job at that. As you can see, as you just mentioned, Hadley, right? So the exploration spending's gone up. It's the right time for listed companies to raise exploration risk capital in the public markets.
You'd rather an A-class manager and a B-class asset, rather than the other way around. The management are the difference, and intellectual honesty is part of the test.
For those who still have an interest and have the investor sign-offs from their own creditors to be able to participate in the old economy commodities, there are actually some pretty good opportunities there.
I think governments around the world are seeing this as being a strategic asset. They're almost looking at we got shut out on oil and gas many years ago, and now we're converting to a new energy source. We want to make sure we can do all this within our borders to the extent possible.
So hello everyone, and welcome to another one-to-one mining investment APAC online content session. Today, to speak on exploration versus mine financing, where is the money going? We have Bert Koth, Managing Director and Partner at Denham Capital Mining Fund. We have Kevin McElligott, Managing Director for Australia at Franco-Nevada. We have Stephen Moderam, Global Head of Asset Development at Noble Group. Peter Rosenauers, Portfolio Manager at Orion Resource Partners, and Hadley Witta, Manager at Lion Selection Group. So thank you everyone for joining us today.
Pleasure.
Thanks
for having us, Amy.
Thank you.
And so exploration budgets and investment in the space seems to be in an upward trend, and this looks like it's going to continue to grow well into 2022. So I wanted to kick off this discussion really looking at, what is your allocation towards exploration versus mine finance? How has this changed over the course of the past year or two? And do you foresee this continuing? So perhaps, Bert, if you'd like to kick us off today with this discussion.
Thank you, Amy. Well, as a private equity firm, we take the view that early stage exploration risk is more for the public markets to bear because it's small dollars with binary risk outcome. So as a private equity firm where you basically have to deploy $50, $100, $200, $300 million checks, you'd rather go into the development risk or into producing assets, but not into early stage exploration risk. So I would say in our investment business, we have no capital set aside for early stage exploration because it's not the type of risk capital, the type of risk exposure that private equity, in our opinion, should assume. So all our capital goes into the development phase or into the production expansion phase or into the acquisition of producing assets.
What about our other panelists today?
I might have a swing at that one if you don't mind, Amy.
Yep.
I think you'll find a lot of investment funds, either they're extremely active or they're extremely lumpy in the way that they deploy funds over time. I'd say that Lion is one of the latter, a lot more lumpy. And I think it's interesting that the trend that we've seen in the market has been that exploration has really kicked up since 2016, 17. Exploration spend, if you look at the various statistical measures of it, has gone up massively. CapEx spend, which is where you see the development costs of new projects and things like that, has almost flatlined in the same time. So they tend to mirror each other in terms of cyclical trends, perhaps with a bit of a lag on the CapEx. We're not seeing that. So the market as a whole, I don't think, is necessarily embracing development as much as it has in the past. And it's probably being led a bit by the industry there. But having said that, from an investing point of view, exploration was something that you could invest in an equity market sense 3-4 years ago, far more cheaply than you could now. There's a hell of a lot of raisings going on at the moment to sponsor exploration, but the equity prices of the companies which are doing that have gone up quite a bit. So I think from a Lion perspective, it's a lot more oriented towards development type things than exploration at the moment, but with that background.
I can make a comment from the perspective of a commodity trader. So I've been at Noble just over 10 years, and we've been through phases of being asset heavy versus asset light. And certainly when we're in those asset heavy phases, we did more at the asset level and more at the early stage level. But these days we're more focused on financing operating mines, and particularly financing the supply chains between those mines and the end users of commodities. I think what's developed to the point of your question, 2020, 21, what's happened? We've had, as we've all seen, these fantastic rallies in commodity prices. So for the traders in the space and many of the financiers in the space, particularly the banks and the commercial banks providing financing into the space, these high commodity prices are placing a huge amount of pressure on the availability of capital to support the supply chains in the form of trade finance limits, hedging facilities, margin calls. It's been, in the last month or so, with the way gas and energy prices have gone, it's been an extremely difficult time for the major traders and the financiers of the major traders in terms of having enough limit just to do their normal business. The value of a cargo of LNG has just skyrocketed, for example. The value of a cargo of coal has gone up 5 times in the last 12 months. And this is all absorbing the capital that's available within the supply chains. But hopefully we'll see some normalisation into 2022 in terms of prices, and that'll relieve a little bit of that pressure.
Oh, that's interesting. It's a bit off topic, but yeah, it's the idea that you're squeezed on capital. It should be a time when you should be raking it in, but instead you probably have to look at throwing more equity in to support the trading or something like that.
Or go back to your bank and ask for some bigger limits if they'll provide them.
Yeah, I wish I could add to this question though, Amy, but I really can't. We're probably worse than Bert there and the private equity guys, because we don't even look at a project until there's a resource. So it's
the same here. It's exactly the same here. I mean, look, the public markets, right? So when a listed company that's earlier in the risk cycle, right, goes out and raises capital, the brokers approach a universe of anything between 10 and 200 people. So everybody ultimately just throws in a small amount of money relative to the individual balance sheet. So all these small amounts of money together mean that a high-risk exploration program with a binary negative or positive outcome can be financed, right? So it's perfectly fine for people in the public market to take a potentially prospective punt, right? But the risk nature is such, you really don't know until you get the drill results back. Whatever beautiful PowerPoint slides you're being shown about prospectivity, historic mine workings, trends, neighboring mines, blah, blah, blah. We've all seen hundreds of those before. Unless the real work is done, you just don't know. And as an institutional investor, right, that invests large amounts of money, we cannot put our capital and our investors' capital into such a binary outcome. It's just that plain simply. So that's why early stage exploration risk is a job for the public markets. And the public market's doing a good job at that. As you can see, I mean, as you just mentioned, Hadley, right? So the exploration spending's gone up. It's the right time for listed companies to raise exploration risk capital in the public markets. We want them to do that because it also means that the deal pipeline for development projects is going to get replenished over time.
Yeah, I think, Amy, from Orion's perspective, I mean, exploration is a very broad topic. There's greenfields, exploration, but there's also a tremendous amount of exploration to extend mine lives that existing companies are undertaking. So if you look at the exploration spend, say, in the Australian gold mining sector, it's very high. You look at what Newcrest are doing, Evolution, Northern Star, etc. Right? So I think this speaks probably more to some other topics, which is brownfields exploration and mine life extension, etc., is just as important as greenfields because of permitting risks, the time it takes to get projects developed, and issues associated around ESG for greenfield development. So I would say exploration funding is being encouraged for existing mines more than than perhaps before, but it also sort of flies under the radar. And yes, to support what Hadley and Bert are saying, greenfields exploration, small caps, a flavour at the moment, and they're getting their equity capital, but yet to prove their results.
I'd be a bit curious, and this is just a segue, Amy, on the same topic, for Bert, Kevin, etc. I mean, as Peter's just said, the contrast between greenfields exploration, and I take your point entirely on the binary outcomes of that, Bert. In fact, it's almost worse than binary, because that sort of suggests a 50-50, and it's almost like a 1 in 100 most of the time. What about, I mean, there must be prospects and projects that you see or even are exposed to where there's the opportunity to convert inferred into indicated or indicated into measured and enhance the fundability of projects. I mean, that to an extent is still exploration that's treated as those dollars if you just divide the two on a black or white basis. I don't know if your appetite for that exists or has shifted over time either.
It's actually interesting. At Orion, we do take a view on converting resources into reserves. If you're providing acquisition finance, as an example, given the prices that people are paying, the last two transactions that have taken place in copper, with South 32 and Sandfire, I mean, they paid above the reserves, in order to get those. So if you want to be part of the funding solution, you really, you need to take a geological view of converting inferred into the long life of mine inventory, or even beyond that, taking some exploration targets. So those sorts of activities do require a budget, and they need to be approved by the financiers, and they need to be encouraged. And when they're successful, they'll result in a longer mine life. So that's great if you're in the equity part of the capital structure, or if you've got a production-linked investment, such as a stream or a royalty. So there's a huge amount of work going on in let's call it development exploration, as opposed to just greenfields. And then that's sort of under the radar. But I think as an investor in mid caps or even larger mining companies, that investors need to look at the public data, and I think it'll be outlined just what the exploration spend is. It's not trivial.
I agree. I agree with you, Hadley, and Peter. I mean, we take a view on convertibility of resources into reserves, right? So I think my relatively binary speech was targeting greenfield exploration. Yeah. I mean, obviously, when we invest into a producing business, or if we buy a producing business, that business will have a budget to drill for continuity of the ore body, and to kind of work towards converting existing resources into reserves, and also to work towards upgrading, for example, inferred resources into higher confidence category. So those risks we're willing to assume, but the assumption of those risks is on the back of something that is already de-risked, right? Like, for example, there is already a certain amount of measured and indicated resources, or there are already existing reserves, or there are already existing production, right? So that if for whatever reason the subsequent exploration work is not as successful as originally anticipated, then you don't lose your shirt, but you maybe only lose one sleeve of your shirt.
Yeah, I guess for us at Franco, just to give a slightly different take on it, is I don't say we fund that conversion per se, but I would say it's just a criteria or a box that we want to tick when we're evaluating an investment, in the sense that, let's say it's already a quality project. There's lots of people looking at it. It's very competitive. We want to see some upside. We know we're going to have to pay through the nose if we want into this, and we want our geologists to tell us, look, we see plenty of upside here. This is going to be bigger in a few years. And if they can't tell us that, and we don't see any upside, it's like, we're not really going to settle for a low discount rate on a base case here. We want to see that upside. We want it to be very clear on the day that we buy in. So I guess that's our take.
I suppose bringing in kind of this discussion on risks, I suppose how do you gauge or how do you measure the amount of risk that you're able to take looking at different projects, or where do you see value, where do you see opportunities, and how do you judge that against the risks within a project?
Who do you want to have a crack at that first, Amy? Let me start off then. I suppose as far as risk goes, I mean, if you just take the example of, say, the gold market, and every commodity fluctuates, so gold's not on its own there, even if it is a bit of a weird commodity. In a $1,000 gold environment, where, say, your history to that point is coming off the back of an $1,800 gold environment, your perceived risk is all downside, even though in reality you've probably just improved your commodity odds quite significantly by having had that downturn in your background, because it means that at least it's not in front of you. So when you're measuring risk, you're always having a think about what the commodity price might do and how that might improve the project, because you don't have to spend a cent to get some upside from commodity price re-rating. But then I guess when you get from the $1,000 gold price environment to another $1,800 gold environment, all of a sudden, I think you'll probably find that a lot of the market, and yourself included, feel a whole lot more optimistic. And so I suppose your appraisal of risk is going to be the opposite, although it's probably wrong on the basis that you've had a hard run, and off the back of hard runs, you often get a bit of a softening and you still don't know what the future is going to be. So I suppose that's one comment on risk. And you're asking about opportunities as well. I suppose one of the things that I suppose any institutional investor assesses opportunities through is if someone comes in looking for $10 million and you've only got $5s to spend, then you're dependent on the rest of the market to make up that money. And some investors are prepared to write the whole ticket themselves, and that often turns into a protracted negotiation. But whilst we're in a market like this, if you can put money to work alongside the rest of the market, you're leveraging your chances of success, being able to spread yourself across a fair few more opportunities, I guess. But you've also got a greater chance of success if the market is rewarding those things. So there's all kinds of things which contribute to, I suppose, the opportunity appraisal and potential, and also the risk. In this market, I suppose if you drill a hole that's only half good, just to use an example of some sort of exploration enterprise, unlikely that the share price will get halved on the basis of it. You'll get another chance to go back and have another look and generate some more results. Whereas if you're doing that in the market of, say, 2015, well, I think you find that share prices would be quite a bit more negative in their response to anything that was perceived as other than spectacularly good news. So that's probably more a host of other segues and things rather than a straight answer, but maybe that gives the other something to think about whilst I'm thinking about my next answer as well.
Well, I mean, since we avoid greenfield exploration risk, our main risk exposure is development risk. And I mean, needless to say, we all know that mining is a very risky industry. I mean, every project got between 20 or 30 variables that can really bite you in the backside and ultimately derail it. So I mean, the most frequently, and I certainly have also one or two big scars in that respect on my own back personally. Technical underwriting mistakes or optimistic underwriting assumptions or insufficiently due diligence technical underwriting assumptions are the main risk for project failure and for capital loss. And the answer and the answer to that is just relentless due diligence, independent peer review of other people's feasibility studies. 90% of the feasibility studies that we come across have been made with a view to the market. Let's not overcapitalize the thing to avoid unnecessary dilution. Let's not overcapitalize the thing with too many contingencies to make sure that the NPV looks as attractive as possible on the PowerPoint slides with which we're going to go to market. All of that stuff. So with approximately 80 to 90% of the feasibility studies that we due diligence, in our opinion, being too optimistic. And again, put that aside. It's just relentless technical due diligence, challenging other people's assumptions, and if necessary, requesting changes to the development plan as a precondition for money flowing in. Because let's face it, there have been non-stop catastrophic capital failures in mining investment on the development side, left, right, and center. Even a recent one in our own portfolio. Honestly, we had a big one, right? And the fact is, and that's probably not what people want to hear at a mining investment conference, but you cannot believe what people tell you. If as a large investor, you believe what management and companies tell you on average, you're going to lose your money.
It's a remarkable observation, but it's true, Bert, that nobody ever makes a mistake by overestimating the capex, do they? There's all sorts of mistakes made on estimating capex, but it's usually because they get the number too low rather than too high.
The average capital overrun in the mining industry over the last 25 years is about 30%. There have been numerous studies on that. So 30%, obviously, it means there's projects that come in on time and on budget, below budget, but there's also projects that 100, 200% above budget, right? So that means feasibility study, margin of error by definition is 10 to 15%. That's what it says in the executive summary of every study. So by definition, when the mining industry over the last 25 years has a 30% capital overrun, it means that on average, most feasibility studies are wrong. That's what it means.
I think speaking on the positive side, risk is where the opportunity is created.
For sure,
if you de-risk every element of an investment, then your returns won't. You're going to get a zero return. So I think, Amy, the point about risk, and it can happen in a greenfields, a brownfields, a distressed opportunity. There's many different circumstances, but the features that really underpin a good return are, first of all, management, and management are really difficult to diligence. But that's the key. You'd rather an A-class manager and a B-class asset, rather than the other way around. So management are the difference, and intellectual honesty is part of the test, as well as skills and experience. And then you've got the other elements, which are about long mine life to allow you to go through various cycles, low position on the cost curve, constructive supply and demand dynamics, forward looking, and occasionally you'll get a bit of a wave behind you. So you get if you're in nickel at any time except the last 12 months over a 10-year period, you probably had a very poor outcome. In the last 12 months, the price of nickel's gone through the roof, but which is lucky for those investors who were invested at the right period of time. But, you can't really bank on having your investments bailed out through commodity price moves. I think everyone on this call will make their investment assumptions based upon consensus pricing and assuming that, the underlying commodity price is not going to underpin their returns, because you just can't bank on that.
I agree, Peter. Management is the most difficult one, the due diligence and integrity of management. That definitely, because there are a lot of people who are just overconfident and not sufficiently competent or not sufficiently experienced, but sell themselves such as they can deliver the projects actually really well, when in reality they can't. And then when things go sideways, they're usually sometimes slow with actually sharing that information. And that is an issue, and that is unfortunately a common feature in many people. But also, to talk about the opportunity, but the reluctance of as you said, Hadley, before, there's this bifurcation where exploration spending goes up, and actually capex profile is more of a flat line, right? I mean, there's actually where the opportunity lies. That the public markets, at least in some commodities, are actually quite reluctant to underwrite the development risk, in some cases, and that's actually exactly where actually the opportunity lies for sector knowledgeable capital to actually come in and partner with management teams to actually get these projects off the ground. I mean, we've recently for annual meeting run these ratios of capital required for development over the market capitalization of single project junior companies, right? And even in the battery metal space, which is probably the sexiest thing out there at the moment in the mining industry, even in that space, the ratio is still at 4.8 times. So that means by average, your typical battery metals junior requires 4.8 times more capital to develop the projects than the underlying companies are worth, right? Then if you move to the metals and minerals that do not serve the energy transition theme, like agro minerals and all of these things, right? The ratio is a staggering 12x. So that means, most of these projects, even if they're projects with legitimate fundamentals, are ultimately not going to get developed because the money isn't out there, or if it's out there, the boards are not going to allow them to be developed because the equity dilution would be too excessive. So there's for sure a very interesting fertile hunting ground. One has just to be very, very aware of the underlying risks.
I would just add to that coming from the perspective of a commodities trader who's still involved in, let's say, some of the old economy commodities, some of the less sexy stuff. Now, granted, we've seen the markets open, as you guys have pointed out, on the exploration side, and certainly the market's more open for the commodities of the future, let's say, but markets definitely closed, both in terms of exploration, development money for old economy commodities. So when I look at asset values and I look at opportunities over the next few years, for those who still have an interest and have the investor sign-offs from their own creditors to be able to participate in the old economy commodities, there are actually some pretty good opportunities there.
Absolutely.
And we've just seen what's happened with the uranium price and the capital moving into that space. Uranium was out of favour due to Fukushima. Europe moved out of nuclear. We've seen what's happened with the Russian gas crisis. Now people are realising that there's an opportunity in nuclear, right? And I think some elements of the coal market could be similar over the next few years with the lack of investment over the preceding 5 or 10 years.
Yeah, I was thinking, so there's been a lot of discussion lately about kind of these new energy metals and the kind of looming shortage that people are predicting. Is this what sort of repercussions are you seeing in the market for, I suppose, further development of kind of projects for key battery materials? What are you seeing, I suppose?
I think we're seeing a lot of government support. So there's government policies. I mean, you see evidence of that in Australia with the participation of NAIF and Export Finance Australia and various debt financing. The key with a lot of these minerals are that really you need to solve the downstream issue. It's not just about mining and producing a concentrate. In order to really distance yourself and become independent of say, China, as an example, you need to create a smelter or a refinery downstream, and that's exceedingly complex and arguably not really a position where a single asset mining company should be involved in something technically as complex as that. Having said that, policy-wise, the governments are helping where they can, but governments can only invest debt. They don't really tend to invest in equity, and equity's the gap, and expertise is the gap. I think the other kind of point to note is that in terms of critical materials and decarbonisation and all those kind of thematics, that some of the massive disruption in the market, which has historically been caused in developing markets, is now being caused in developed markets. I mean, if you look at just in recent weeks, it's the energy, kind of the energy policies that Europe's adopted that's caused the spike in copper price and the spike in zinc as smelters are closing down because energy prices are too high. And yet the countries that may have caused a problem historically, South Africa and Guinea and Mali, where there've been, localised political issues, the mining companies are operating safe and sound. So, there is a changing dynamic in terms of jurisdictional risk. It's not as clear cut as it might have been, a number of years ago. But there are some policy changes afoot, and also some fiscal conservatism in some of the more volatile economies, which is actually quite interesting. Makes some of these development economies actually interesting places to invest.
I'd just add to that in terms of the particularly the the rare earths, some of the rare earths projects we're involved in, and the need at a feasibility stage for the companies to really map out their supply chains, right, from mine, further processing through to consumer. At the funding stage, it's not something that can sort of come later. You don't finance your mine and then worry about who you're going to sell to and how you're going to process it later, because those supply chains have already become bifurcated between the West and the East, let's say, to put it simply, and then more specifically, will you go into Europe? Because within Europe, within some countries right now, there are good subsidies available to invest in the downstream. Obviously, the US, if you can get the right connections into consumers of your material there for battery metals, then that creates a funding opportunity as well in terms of their export finance group. So there's a lot of development financing decisions that go hand in hand with how you're going to build your supply chain at the feasibility stage. And it's very political.
Particularly, to add to that point, Steve, I mean, if you consider the number of sole project companies or, non-producing companies that are trying to move into that space, and in rare earths, it's probably a mixture of developers and existing producers. In something like lithium, there's not too many existing miners who are moving into lithium to build lithium mines. So a lot of the companies which have been trying to do this are trying to manage those risks in the first instance, rather than off the basis of existing practices or, management experience is one thing, but and then they're confronted with a market, and lithium's a great example, particularly when we're talking about the forward-facing commodities, because to sell lithium, you need to enter a market which is small to start with, expanding, and it's got very, very lumpy new supply coming, and fairly, I think you'd also say, lumpy new demand coming on. And if they don't align quite well, then you end up with quite severe movements, as small amounts of buying on top of the existing market can push the price in one direction or the other quite severely. And that's very difficult to predict, but you're also trying to sell a product which, there are some people who are very experienced in it, but there's not very many of them. So developing those projects relies on experience, which is quite rare in the market. So the ability to finance those things, I think, is fascinating. There's been a high degree of equity market participation there, and I wonder if that's going to shift towards the debt markets as that experience grows, and some of the more established and worldly commodity traders, if you like, and banks who deal quite closely in that space become more familiar with it.
I mean, just one statement. I mean, the energy transition is not going to happen without a significant increase in primary mining activity. So if you look at the raw materials intensity of just everything that's being proposed, from the expansion of the renewable energy footprint to electric vehicles, so it will require massive supply increases in most metals and minerals, where in some cases it's difficult to see where that supply response is actually really going to come from. So I think that's good news for all of us. On the battery metals in particular, I mean, it's complicated. I mean, as you all correctly say, right? I mean, lithium, yes, the most frequently found element in the Earth crust, but for lithium deposits to be really commercially viable, it has to meet a lot of criteria. It has to be big enough to justify building the hydroxide plant. Yeah, it has to be metallurgically relatively benign, etc., etc. So once it shouldn't be too far away from where the battery or the car production is. Otherwise, you have a CO2 intensive supply chain, etc., etc. So when you actually have all the boxes that it needs to tick, there's actually not that many projects left where you can actually really put your money in, right? And so it goes through all of the battery metals, right? Then you go down to graphite, consistency of quality is a problem. Then it has to compete with synthetic graphite, because synthetic graphite actually there's a guaranteed quality spec that can be delivered to the battery manufacturers. Then you go to electrolytic manganese. That's a market that's not technically dominated by China, etc., etc. So the supply response that's needed for battery metals to make it happen, it's complicated. Yeah. And I mean, yes, the equity market at the moment are willing to underwrite that, but I think that's going to be an interesting question if one or two of those blow up because of the underlying technical risks, right? if that positive market momentum is actually going to continue. Because if you have one or two massive failures, because a lot of the things are technically very, very complicated. Yeah, I don't think the public markets appreciate that.
Well, I think, Bert, if you take agricultural products, sulfated potash as an example in Australia, I think.
Yes.
Right. I mean, it flows. The conversation saying, "Oh, I've got solar and wind evaporation," flows off the tongue, but the practicalities of pond chemistry and actually building and commissioning these plants is so complex. It's been done globally, but yeah, I think there's probably an underestimation of risk by everyone involved: management, equity partners, etc. So,
and that's not even a marketing risk. That's pumping it out of the ground, which is supposedly simple, and then the wind and sun helping evaporate it, which you make a small twiddle on your assumptions there, and all of a sudden your ponds are still quite wet when you need them to be dry. And separating salts, which are physically identical but chemically a little bit distinct, can be quite difficult.
That sounds like we've all looked at these projects recently, because it's all.
Well, I put one of the products on my eggs this morning, Kevin. So so it's really close for me. It's close to the heart. No, I mean.
So you wanted to succeed to maintain your breakfast in the morning.
We all want to have a double salt with a bit of sodium and potassium chloride, and magnesium chloride on your eggs. No, look, it's complex. To your point, but it's so complex.
What I find interesting, not to get away from the battery metals, but how they come in groups, because right now we're seeing the group of potash projects. And I remember, I'm going to sound really old, I remember when there was a group of laterite nickel projects being developed in Australia, and they all, if anybody wants a story of how things are going to look for some of these other ones, you just go back and read a few chapters on the history of those and how they are for the first 5 or 10 years. It was horrific for the people who were involved. One of them survived, and with a lot of equity put in by a big player over many years. And we're going to see that with some of these other metals. The interesting, I think what's different is there was the announcement, you mentioned NAIF there, Peter, but I think the Australian government just announced some other fund. It's a bit vague, it's some other $2 billion investment fund. And I think governments around the world are seeing this as being a strategic asset. They're almost looking at we got shut out on oil and gas many years ago, and now we're converting to a new energy source. We want to make sure we can do all this within our borders to the extent possible and not sort of miss the boat in some respects. So if there's an opportunity, governments are going to be more interested in this than they typically are in other mining projects, I think.
That's important.
It's very true. And I was going to say, Bert, just a great example of that is there's a terrific Australian company. Everyone's aware of the Dubbo Zirconium project that's been around for many, many years. And really, it's through the national policy of Korea in marshalling a combination of Korean finance, be that equity as well as debt and some technology, construction capacity. Korea Inc. has marshalled, it's come down, and it's currently, working with Australian Strategic Metals to get that project up and running. That is a really sensible way, I think, of addressing some of these issues. Whereas, in Australia, just throwing low-cost debt at a project is a partial solution and doesn't address the overall issues. So I think as a country, we could do things a lot better.
But I agree with, if government money can help cushion the risk that is assumed in the complex downstream processing that is required in these technology metals, in these battery metals, that is actually very helpful to the overall cause. And I would actually argue it is strategic for countries or blocks of countries to have certain critical supply chains under their control within their border in a geopolitically uncertain environment. Yeah. So it is actually critical, and it is actually strategic, right? So I think that, for example, the Australian government kind of underwrites partially the risk of building rare earth downstream processing, for example, right? I think that is important. because after what happened in, I mean, let's face it, with the kind of the company like Linus, right? Initially for the investors, it was not such a great experience, the building of the downstream processing facilities in Malaysia, right? So they actually have government coming in and actually helping to cushion the separation, the building of these downstream capabilities and the risks associated with them, right? That is actually very important, because that then in turn also unlocks kind of further equity coming in when they actually see that government is at least there for the risk sharing economically, yeah. And that's what's starting to happen in the US as well. That is actually a very constructive role that government is playing here in this kind of technology metals and battery metals.
Yeah.
I was going to ask if, these supply chain issues and the government intervention, is that really a result of kind of the shutdowns that we saw during COVID, when kind of, everything was shut down, and now we're seeing these kind of resulting impacts in the global supply chains? Is that really all kind of an effect of that? Do you see this kind of domestic supply chain idea? Do you see that growing kind of globally?
I think it's deglobalization is just the thematic that's been around for some time, and COVID accelerated, governments thinking on that regard. And now it's accentuated even more so by elevated freight rates. All the ports in the world are kind of, backlogged, et cetera, et cetera. So I think the thematic was existent before COVID, and what's happened is it's accelerating.
Yeah, I would agree with that, Peter. I think if you look at countries like Indonesia, in terms of what they were doing on the bauxite export side and on the nickel ore export side, the trend to force new projects and even existing large projects, mining projects in Indonesia, to onshore their downstream was already there. So it doesn't mean that China's not involved, it's just brought capital onshore. So I would agree with Peter that those trends are already there. I think the supply chain impacts that we see due to COVID are transitory. I mean, we deal with it every day in my company, and goodness knows, we haven't seen Cape-size freight rates at these levels for many, many years. But I think it will pass, and it will normalise over the next few years. But it's still going to require more capital to come into the sector, and there are still supply side issues on not all commodities, but certain commodities to resolve. And I guess unpicking that is where the opportunities are.
I'm just curious to hear your take on the freight rates, because it came on my radar screen recently when I saw what the numbers were. So they're obviously eye-popping. Is it a blip, or is this something? Is this a trend? Is this?
Yeah, I think it's
squeeze somewhere.
If you look at the day rates on Capes, they're at levels that we haven't seen probably since probably for over a decade. Right? A lot of it started off with issues around crew changes and the inefficiencies of being able to run your fleet. So I think that's ultimately the key to it, is when can fleets get back to being able to run the way they used to more efficiently? At the moment, it's just very, very difficult to send a ship from A to B, do your bunkering, do your crew changes and all that efficiently. You're often having to stop in a third country to switch crews and bunker and things like that. So I think that's part of the story. And then you'll also gradually see some switching. So between Capes and Panamaxes, for example, you can't have such a disparity, and you'll see people splitting cargoes and things like that, particularly on the bulk. So I think it'll solve itself eventually, but it'll take some time, and COVID won't help.
I think the other two kind of, I agree with you totally, Peter. So there's this deglobalization trend, right? But I think I think there's two more drivers to that. One is the desire to have low CO2 intensity in the supply chain, right? So for example, if you're a vehicle producer in Europe, you want the battery production to be close to you, and the battery production wants to have the lithium supply as close as possible as well, right? So that then kind of feeds through, okay, for example, whereas there are European lithium deposits or lithium deposits close to Europe, for example, that can be exploited in a commercially viable manner. So there's also that kind of regional supply chain thinking to keep it all close together to minimize the transport distances under the cost. That's certainly true in the electric vehicle and the battery space. And then there's the other theme that's also, in my opinion, not transitory, is just geopolitics. I mean, there are geopolitical tensions out there that are ideological, and they might not go away for several decades. And they also prompt governance now to think, okay, metals or minerals that we need for key industries, that we need for military purposes, we want to have those supply chains within our sphere of influence, at least, right? So I think, yeah, inflation. I agree with you, Steve. That's transitory. We also see this in businesses that we are financing, this issue with the freight rates, and as you say, is the crew changes and all of these things, and we think that's going to play itself out and balance itself out probably over the next 2 years as the world hopefully gets back to normal post-COVID. But the other two themes where you kind of want to reduce the CO2 intensity in the supply chain, and where you want to hedge yourself against negative geopolitics, I think those two themes are here to stay for as long as all of us here are economically active.
And so I guess kind of looking to start wrapping things up, I just wanted to, check with everyone to see, I suppose, over the near term, where are you focusing? What kind of trends do you foresee for the coming years? What can people be, I suppose, looking out for in terms of this financing?
We're very constructive about wood. No, I think, Amy, we've covered it, to a great extent. I mean, I think Bert just did there. You've got deglobalization, you've got, decarbonisation, battery materials, etc. Geopolitical events, I think that, they're the investment thematics that take place, all in the context of, each of those breaks up into sub-stories. But I think, they're really the big drivers. So from a commodity point of view, who are the winners in that regard? Critical materials. There's a whole understudied part of the market in industrial materials, but some of those assets are winners, will be winners. It possibly puts a question mark around the precious metals market as to, well, why do you need to be in that? Why do you need to continue to mine gold? What role does it play, etc. That's more of an ESG. Yeah.
Oh, sorry. Keep going.
No. We don't. I mean, look, obviously, Kevin, we're heavily invested in the precious metals market, but just like in terms of an industry thematic.
I think, and we're the same. We're big on gold, but we look at other stuff, other commodities. I think what right now I find is sort of clouding a picture of trying to make, trying to pick a trend going forward is we've got a number of commodities that are at or near record prices. And you're looking at them and saying, will this persist? Is there a way we can participate in this? We're not trying to pick a big longer term trend. We're just looking at sky high nickel prices or copper prices or zinc prices and saying is this legit? Is this something we can try and capitalize on, or is this something that's going to blow off in the next 12 months? So I wish I could say we're more long term thinking than that, but when we get outside of precious metals, it's a bit more selective.
Yeah, it is, because if you look at the price performance since the start of COVID, almost everything is up materially. And actually, precious metals is the one thing that's been relatively subdued, interestingly. But the prices have never stayed high for a really long time. They've always come down. It's a cyclical industry. So you invest into the current high prices at your own peril, obviously. But I think it just all goes back to first principles, right? ignore the current high prices. As Peter said, you underwrite consensus, long-term cycle average prices, you know. You gotta make sure there's a long life. You gotta make sure it's reasonably low cost. We've all heard that before. There's nothing new, right? And so you just gotta make sure that the underlying project fundamentals are sound, yeah. And if a deal cannot be done because counterparties insist that you price in years of high prices, okay, then one just walks. It's that simple.
There's plenty of replacement capital around for that at the moment, isn't there, Bert? And the point is that for the long money, it's becoming an environment where it's become harder to take that risk, because I think what we're all aware of is, first of all, that mining is very cyclical. The cycles are driven often by the commodity prices going up and then coming back down. And there's a high degree of connectivity to the broader economy and the global equity market. And I don't think anyone would object to a statement like global equities are trading at, you know, surprising valuations compared to earnings. And the outlook is pricing a lot of success. And environments like this, a catalyst comes along and it tends to take a lot of liquidity out of the market as it all retreats to some form of stability. And I think that's probably the biggest risk, which everybody is most concerned about if you're invested in equities or anything that relies on a return out of a project, is what effect will something like that have? Something like an Evergrande in China could have been that kind of catalyst. It doesn't look like it has been so far. There will be others. And, you know, we're at a point now where that music could stop. And if it does, then it's probably going to change the future for the immediate future for a lot of the industry there.
Yeah,
Sorry, Amy, that's probably not quite the optimistic outlook you were hoping for, but I think it's a risk we've got to acknowledge.
No, but look, it's a cyclical industry. I mean, you know, everybody who invests in the belief that prices will always stay high, these are usually the people who lose their money. Obviously. I mean, obviously, you got to take a look at it as on a cycle average basis, obviously.
Yeah, I'd make a similar comment. You know, I think whilst high prices are nice, they're unlikely to stay high for a long period of time, but it's also the volatility that we've seen. It's incredibly difficult to run a mining business, let alone supply chains, with the sort of volatility that we've seen recently. And the comment I made at the start about the amount of capital that needs to get dedicated to run supply chains with high prices is one, but the volatility is another. You know, it's just very, very difficult for buyers and sellers in any market to manage the risks of that sort of volatility. You know, so between a producer and a consumer of commodities, it's tough.
Well, I don't have much follow-up to that. Thank you. Thanks for this discussion. It's been quite kind of interesting to hear all your thoughts about kind of what you see happening on the financing side of things. So everyone, thank you for taking part today.
Thank you, Amy.
We hope to see everyone at a live event soon. I know Sydney's opening up. Hopefully the rest of us can start traveling again soon as well.
Thank you,
Amy.
Thanks, Amy.
Thank you.